Hello everyone, welcome to iTube classes. In this video, we are going to discuss an economic question. This question was asked in 2021 UPSC Prelims with reference to the Indian economy. Demand pull inflation can be increased by which of the following? Expansionary policy, 2. Fiscal policy, 3. Inflation indexed wages, 4. Higher purchasing power, 5. Rising interest rate. Select the correct answer using the code given below. So if we see, this statement talks about the demand pull inflation. So we need to go into deeper sense of understanding that what is demand pull inflation and what are the factors that influence the demand pull inflation. So one by one we are going to see these dimensions, and then we are going to attempt this question, that how to approach this question. Okay, so in this video we are going to discuss expansionary policy, fiscal stimulus, inflation indexed wages, higher purchasing power, and rising interest rate. So let's talk about the expansionary policy. How expansionary policy impacts the demand pull inflation, and what is the meaning of expansionary policy? As name indicates, expansion means when something is spreading. Expansion means when something is increasing. So here what we are doing, in expansionary policy, government tries to expand the economy. And how to expand the economy? By boosting demand. Because demand has a direct relationship on our inflation and our economic growth. If people demand more, it means there is going to be more production. More production leads to more employment, and more employment leads to growth of the economy. So this is how things work. Expansionary policies are those policies which are taken by our central bank or by the government, where the primary focus is to boost the demand. How to boost the demand? If business people, they are going to have more money, so they are going to invest more. So more investment or more money in the system leads to more demand. Sometimes what happens, government also takes some measures to deficit the finance. It means that if government is spending more and government has less income, so that gap is fulfilled by printing some money. So printing of money also can be lead to this expansionary policy. So more lending to the business. Basic purpose is to boost the demand. And when economy grows, it leads to demand pull inflation. This is called Keynesian idea. He said that when economy goes down, government needs to take expansionary policy. Government needs to infuse more money in the market. Government needs to motivate the business people to expand their business so that economy can be revived. Second, the second aspect that we have is the fiscal stimulus. What is fiscal stimulus? How this is different from the expansionary policy? Let me tell you. Expansionary policy is actually more to do with the bank, or we can say in this case our RBI. But fiscal stimulus is actually has to do more with the government. In our expansionary policy, central bank or RBI takes steps like they can reduce the interest rate so that people can have more money. But here government actually participates in the fiscal stimulus. So government takes such steps so that economy can be boosted. Stimulus का मतलब होता है, stimulus means when you do something to actually accentuate the process, when you do something to increase the process. It is something like a chemical reaction. When a chemical reaction is slow, so what we do, we add some extra catalyst to it so that that chemical reaction can be little bit faster. In that sense, this is called fiscal stimulus. So here what we do, government can actually boost the decreasing economy, sluggish economy, by providing the boost. How this boost is provided? By reducing the taxes. So if government reduces the taxes, suppose let's say income tax, so you are going to have more money in your hand because you need to pay less to the government. It is called specific and conservative. What was happening in the previous case of the expansionary policy, everybody was having more money. But here government sometimes what they do, they actually target a particular place or a particular section of the economy, like textile. If there is a less demand in textile, so government can provide special incentives to the textile industry. They can provide some incentives, they can provide some subsidies. So sometimes fiscal stimulus can lead to a specific aspect of the economy as well. During the time of pandemic, automobile industry was going very down. So what government did, they provided some incentives to the automobile economy. So this is how fiscal stimulus can be provided to a specific key sector of the economy. So what happens when government provides such kind of help or stimulus? The companies hire more people. When they hire more people, then economy again grows. When they hire more people, they provide them salary and they demand more. So yes, fiscal stimulus also leads to demand pull inflation, because people start demanding more when they have more money in their hand, right? So the next aspect that we have is inflation indexed wages. How does it work? Look, because of the inflation, value of the money goes down. It means that purchasing power of the consumer also goes down with the inflation. Let me give an example. Suppose in 2021, you were able to purchase 12 bananas or 1 dozen banana in 50 rupees. But because of the inflation, price of the banana goes up. So in 2022, in order to purchase same 12 bananas, you need to pay 70 rupees. So you need to pay more money to purchase, to buy the same stuff. It means that value of your money actually going down, and you need to pay more. It means your purchasing power is now going to go down. So how to balance it? If only price is rising and your salary is not rising, it means you are going to feel lot of pressure because of inflation. But if your salary increases according to the prices, it means you are not going to feel any negative impact of the inflation. This is how inflation indexed wages works. So if your wages, your salary is increasing according to the inflation, you are not going to feel any negative impact because of the inflation. This is how things work. So the next dimension that we have is high purchasing power. Actually, we have already discussed it. High purchasing power means now you have more money in your pocket to purchase the stuff that you need. How does it happen? Suppose your boss or your company is raising your salary, so you have more money in your pocket. Suppose government decreases the income tax, so now you need to pay less money to the government and you are going to have more money in your pocket to buy stuff. Suppose interest rates are very low. You go to a bank, bank is going to charge very low interest rate on that particular loan, so you are going to have more loan, you are going to have more money, and when you have more money, you are going to spend more money to buy things, goods and services, and that is how it will lead to more demand, and this is going to lead the demand pull inflation. So the next aspect that we have is interest rate. It is very simple to understand. What happens if you are going to a bank and bank is going to charge very high interest rate on your borrowing? It means you are discouraged to take loan. So because of it, money becomes very expensive. So Tata, Birla, Ambani, business people and consumers like us, we are not going to take or borrow money from the bank if interest rates are very high. So what happens, because nobody is taking loan from the bank, money supply is going to be reduced in the market, and when you do not have money, you are not going to demand anything because you do not have money, and that is why it is never going to lead to demand pull inflation. So the crux of the whole thing is this: if you have more money, if money supply is more in the market, people are going to demand more, and it will lead to demand pull inflation. So from all these dimensions that we have discussed, we can clearly now answer this question. So it is actually talking about the demand pull inflation and what are the factors. Expansionary policy, yes, because expansionary policy leads to more money supply, right? So this is the correct statement. Fiscal stimulus, of course, because government is going to provide help to a lot of sectors, so this is also going to lead demand pull inflation. Inflation indexed wages, no. If your salary is increasing according to the inflation, this is not going to lead any inflation. Higher purchasing power, of course, if people are going to have more money, they are going to purchase more goods and services. This is also going to lead to inflation. Rising interest rate, no. Actually, rising interest rate decreases the demand pull inflation. So this is totally contradictory. So we have only 1, 2 and 4. And this question was asked in 2021 UPSC Prelims. It is a very conceptual based question. Nothing to wrote about it, nothing to memorize different kind of stuff. If you know the basics of the economy, then this question can be easily handled, right? I think you got the point now. And if you want such more videos, please subscribe to our channel. If you like this explanation, please like our video, and for the future notifications you can also click on the bell button. This is all for the day. Thank you very much. All the best. Jai Hind.